Hello, everybody. Welcome to Wednesday. The S&P 500 was down a little bit more than 1.5% today. This came after the Federal Reserve meeting. They meet on Tuesdays, and on Wednesdays they come out and say what they're going to do. They didn't change the rates. He gives a speech, and then he does question and answer. I thought his speech was really interesting in the sense that it was different, obviously than Chairman Powell. We got a lot of things going on right now that are kind of creating some volatility. I mean, first of all, you've got, the situation in Iran continues to, kind of worsen, at least here in the short term. Um, I don't think Iran's going to stop. At the very beginning, they talked about trying to affect a regime change through the midterms by creating this economic turmoil. I don't think they've given up on that. I think, they've basically backed off a few times to stretch this out and get us to the midterms. They'd like to see higher oil prices and gas prices. So that's going to continue. And then you've got the tariffs that expired last Friday, which of course created a whole new set of tariffs, which are higher than they were last Friday, covering more products as far as that goes. So those things are coming. And now we've got a new Fed chairman who has a different way of doing things. So one of the things he's doing quite different is he's not getting forward guidance. Matter of fact, not even talking that much about why they did what they did. So even reverse guidance, talking about what happened. And he wants the market to be able to focus on the market and the data. And he specifically talked about, he wants the market to be focusing on the ball and not the referee. And he gave an example of, the yields on bonds have come up over the last 42 days since he's been Fed governor. And he thinks that's the market kind of paying attention to the data. And if yields come up on bonds, that kind of slows things down, which will help fight inflation. Means the Federal Reserve may not have to raise rates as often also. So unfortunately, right after he was done, the yield on the 30-year bond went up quite a bit. And that seemed to kind of really drive the market down. Matter of fact, the yield on the 30-year went up to a high that we haven't seen since 2007. Now, keep in mind on a perspective basis that we're at 3.5 to 3.75% when it comes to the Fed funds rate. And so the Fed funds rate was at 6% in the best 5 years of the history of stock market. That was from 95 to 2000. So I think we're fine on interest rates, even with the yields on these bonds, kind of creeping up. The one problem with yield on bonds coming up a lot is that it just becomes a competitive asset class to stocks. If you can get a high enough rate of return on a guaranteed basis, say from a US Treasury, maybe you don't take as much risk in stocks. And so you start to see more money come over to bonds. So that type of thing can happen. But I don't think we're there yet. There's too much money to be made in the stock market, especially over the longer term, compared to what the bond market is able to do, at least at these levels, that's for sure. And so that's, really interesting. Now, here are the things that I think you should kind of hang your hat on. First of all, I think we're going to end up with a buying opportunity here at some point in time because Marsh talked about how good the economy was and how good the employment situation was. And he talked about capital expenditure growth being one of the big drivers, which is what I've been talking about ever since. It's not a mystery, but he did put a number to it. The AI centered companies have increased their capital expenditures by 20% a quarter for the last 4 quarters in a row. That's a lot. And it's a huge dollar amount. And it's the whole thing. It's driving the whole economy. And it doesn't look like that's slowing down anytime soon as far as that goes. It does create an interesting problem in that it's helping the economy, it's keeping us out of recession, but it's also kind of pushing the economy into a hotter zone, not hot zone, but more so. And it creates a bit more of inflationary pressure, which is, of course, what they're trying to stop. So I expect to see some rate increases in September. Wouldn't be surprised to see that. I expect to see some weakness potentially in the market here. Just on a normal midterm year basis, you end up with a soft market between the end of June and the end of September. That's the average. That's how it works. Throw in the Iran situation, the tariff situation, and a new Fed governor, you're bound to have some weaknesses here. However, those weaknesses in the stock market are not going to be dramatically affecting the economy, and they're certainly not going to be affecting the capital expenditure money that's being spent. And so if that continues to go, we could have a good run here. And again, in a midterm year, we actually do have a normal, nice run in October, November, and even December that would come up. So again, I think there'll be some buying opportunities. Maybe not yet. I think maybe we get a little bit softer. We are still going sideways, since the end of May. We're in that still range, even though we're down today, we're still in the same range. We're towards the bottom of it. Maybe we fall out of it. I wouldn't be surprised. We end up with a 10% downturn on average, once a year. So maybe this is what will be, the issue that happens here. We did see a 10% downturn on the Nasdaq 100 already so far from its high, but it had spiked up quite a bit, and that's kind of the chip sell-off that's happening as far as that goes. So, I'm not too worried about what's happening here. Again, as long as the basics are still there, as long as the employment is still working, as long as these other things are happening. Of course, they talked about the biggest problem, of course, is this inflationary pressure. We did have a good, numbers that came out of the last month, but they said that those, aren't going to have a big impact on their decision-making capabilities as far as that goes. So, really interesting day. I think this is a fascinating time frame to see all these things kind of coming together. But the backdrop is still quite positive. You're going to hear all the negative, and that's the things everybody will hang their hat on and what have you. But they're ignoring the positive here. I mentioned this before, like with the data centers, we're hearing all the negative stuff about them, but we're not hearing about the expenditures helping the economy, helping unemployment, helping, the overall, situation as far as that goes. And so there are still good things happening. The stock market is still, I think, in a good spot. It did have a unbelievable run after that April-May situation out of the Iran low that happened, and we're still just kind of taking some of that back off the table, which I have no problem with whatsoever, because it got really overcooked as far as I'm concerned. So look forward to being able to see you again on Friday. We'll not do a video tomorrow. We're not going to have a show on Friday, but I'll do a summary on Friday. And then I'm out of town next week, so I won't have any videos, but I'll try to do a good summary for this week on Friday. Talk to you then. Thank you.